Good evening. This is Doc Severson for the Theo Knight Report for Thursday, May 4th. By far the strongest index has been the NASDAQ 100 here, and the NQ futures are showing this, but there's only a limit to how far these things can run up the hill, right? So we have now a condition where we have across the board, once again, and this goes back to a couple of months ago. We had this on all the major indices, but right now the NASDAQ has grabbed the baton and run forward with it, but looks a little winded right now because we're seeing not only at the monthly chart, we're just seeing an extraordinarily linear move here. Typically, when we see this level, we see some type of reaction from here. Again, some type of reaction is normal from these levels of exhaustion. Right across the board, not only monthly, but also weekly, and then also daily is really stretched right now. So this is where we would expect to see at the very least some type of at least a small pattern, at least beginning on the daily chart, and we'll see whether or not it actually does spread to the weekly chart where we could start to see things move down. And it just expand the range, right? I'm not looking for this thing to sell off. All I'm looking for this chart to do is perhaps reach down a little bit and expand the range. Think about running up the side of a mountain. You can't go for very far until you at least take a rest, and then you're ready to go to the next base leg. Now, the reason I'm concerned about this is because, again, it seems like right now what's driving the market is just a few of the studs, right? So this is the same problem that we had back in 2015 where markets were at all-time highs, but we continued to see stocks overall start to diverge from these leaders to the upside as fewer and fewer of these stocks were above their respective 50-day moving averages. And we're seeing that definite, right, divergence show up right now. I've been showing this again and again, but this is a real warning when we do start to see these come up again, because this is typically when we start to see a reaction that, quote-unquote, nobody sees coming. Now, if we go over to the S&P 500, in this case, I'm just looking at the S&P ETF, which is the spiders that everybody trades, right? So what we're seeing here is that this level of exhaustion, which is still hanging over this market on the monthly chart, is perhaps setting up an interesting move here on the weekly chart, because right now, unless this is able to get up and beyond that 240 level, which looms overhead, right now this is showing as a potential lower high. Now this is where things get interesting, because a descending pattern like this, when you see a breakout like what we saw over the past week, right? We saw the breakout after the French election, a little bit of follow-ons past that. This is where everybody really gets bullish. And if we look at the volatility indices, they've absolutely collapsed, right? So all the fear is out of the market. All the complacency is back into the market. So this is where people are going long here. Lower highs are a very dangerous technical condition, because if it's unable to get above there, all these people that went long up here, think about all those people, like think about a sailboat leaning over the side of a sailboat fighting against the wind, right? Trying to keep it upright. Then what happens if the wind shifts? All of a sudden, all those people go on the drink. This is typically when we start to get a strong move to the downside, catches everybody off guard, and this is where the weak hands really just hurl out their positions overboard. Now, one of the things that we've been watching like a hawk lately is the expected move on a weekly basis. So on the spiders, as we got to Monday, so Monday came along, right? And then, it was right around here. There's a 68.2% chance of staying within the expected move, which is just below 240 to the upside and is just over 236 to the downside. And we have not even sniffed getting near that yet. So I don't know if that's going to occur by tomorrow. If there's a huge disappointment in the jobs number, and don't forget that the jobs number, let's bring that down here, is slated for consensus 185,000. And last time we didn't get anywhere near that at about 98,000. So if we're going to have another big miss, all of a sudden, all this monetary policy that's been set up based on factoring in growth could be on the wrong side of that wind and could get knocked overboard. So this could start to, kind of a domino effect if these things start to happen. So definitely we've got to watch that jobs report tomorrow morning, 8:30 Eastern, 7:30 Central, before the market opens up, and we'll get a good read in terms of, if the market is going to have a problem with that number. Then again, we could have a strong number, everything gets swept under the carpet, volatility futures drop again, and market goes right back into complacency mode. Now, speaking of that expected move, something to watch here recently has been just that the nature of the price hitting those expected move targets. So you can see over the last 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks, not counting this week yet, we've hit those just about every week. Even the yellow means that we've gotten very, very close to touching those expected move targets. So this would be, if we don't hit that target, one of those two expected move targets, this would be only the second time out of the last 10 that the price did not move to one side of the expected move envelope or the other. And as we all know, range contraction leads to range expansion. So one more chart here. Let's look at the Russell 2000. The Russell 2000 has been very weak. And again, talking about an overthrow here, this could be a wicked overthrow. If this thing, think of a clothesline here that's set up, and think of, there's the clothesline here, and think of a towel wrapping over the top of this thing and coming back down. We have seen some nasty overthrows on the Russell before, such as this one on the weekly or the monthly chart. Nasty overthrow here back in early 2015. Should have broken out to the upside, did not. So we need to watch this one carefully. The Russell always is a potential canary in a coal mine, right? So this is really reading fund manager sentiment that's out there, because these are the riskiest assets out there in terms of equities, because they're fairly illiquid and they don't get distributed very quickly. When it comes down to that, they move the market against them if they have to dump them in a hurry. So to kind of wrap things up here, all it's going to take is one piece of information that is not priced into today's current mix to kind of upset the apple cart here. So this is a market that thinks that it's priced to perfection right now, but anything could upset that. So be very cautious. I'm not suggesting everybody to short the market at these levels, but make sure that you understand your risk and consider getting some protection in here right now while risk premium is relatively cheap right now. That's it for today's report. Thanks for listening, folks. We'll see you tomorrow.